Hey guys, Bob Hertzog here with Bob Hertzog Coaching. I'm sitting here today with all of our favorite loan officers, Lizy Hoeffer. If you're getting this video, many of you are my past clients that have probably already worked with Lizy. So it's been a while since you've seen her, talked to her, I imagine. But I wanted her to come on today and just kind of share what the heck is going on with this mortgage market, because I mean, depending on what you read or watch on the news, everyone's got a different opinion. And you know what they say about opinions. I won't go into what they're like, but um, I thought I'd bring on the true expert, one of my very best friends and definitely my favorite loan officer, to kind of share with us what the heck's going on. So, Lizy, when are we going to see rates at 3% again? That's what everyone wants to know.
Well, hi guys. Thank you so much, first and foremost, for your business and for trusting me and Bob to help you throughout the years. You know, it is a really challenging market. Most of you are in a really wonderful position. You know, 85% of people with a mortgage have a mortgage under 5%, which is probably you. Otherwise, you have your house paid and free and clear. Now, there are some advantages to buying in a market that has high interest. Oftentimes I'm asked, like, how do you time the market appropriately? And the best times to get the best price in house is actually when there's the least amount of competition, and high interest rates are making those conditions favorable for people who want to put the least amount of money out of pocket. So sellers in this marketplace are having to pay for closing costs. And, you know, if interest rates continue to rise, we will see a pullback in prices. It is not going to be a crash. Housing in this market is very, very insulated because of the fact that 47% of homeowners own their home free and clear. And majority of people, like I said, have low rates. So there isn't fear of like a housing crash and like a ton of inventory hitting the market.
Wow.
But there will be more inventory with people wanting to relinquish Airbnbs and investment properties. And, you know, with less demand, people can't charge top dollar for their houses. So,
Right.
you know, we will see if interest rates, you know, creep up to the 8%, like some people are thinking, a pullback in the market. And that's to be expected. And when that happens, that's when you're going to get the best price.
Right.
Now, one thing to consider is that, you know, there's still a large percentage of the population that is just not buying right now because they're waiting for lower rate opportunities. They estimate anywhere between like 3 and 5 million people, you know, and that's when rates get in the low sixes, right? And so when that happens, there's still, we have underbuilt for a very long time. There isn't enough houses for population. We'll go right back to the bidding wars that we saw in 2020 and 2021. So we are in this like very, very weird time where it's hard to buy a house because of affordability, because of high rates. But then when the market turns, you'll need a lot more cash to pay over list price, over appraised value. You'll have to pay a lot more concessions during that time period. So I would recommend that if somebody has a need to purchase, they buy now, refinance later. We are confident that there'll be an opportunity to refinance later because the economy will need to be stimulated. Real estate and real estate-like verticals make up 30% of the overall GDP, you know, the US economy. And so at some point, they will have to use quantitative easing to buy mortgage-backed securities, which will bring them down, and they'll be in a lot more favorable position at that point in time, but it's hard to say when exactly. So lots of things going on. So if you're looking to buy right now, you're going to get a deal in price. I definitely think there'll be a time in the next like 2 years to refinance.
Next 2 years, you think that's kind of when the refinancing boom might kick in again?
You know, I think look, and this is based on the data today. I'm not a clairvoyant,
Right.
but like they're saying the expectation was for the end of this year, but then we had a debt ceiling issue, and then we've had the cost of energy go up. We've still had that the war in Ukraine. So there's some things that are really preventing our ability to correct. But from here to the end of the year, the metrics that they've been using for inflation should go down significantly because they use lagging data for shelter. And so we should start seeing some improvements. But because it's taken so long to see these improvements, just know that the correction takes equally as long. So it's been over, gosh, guys, it's been over a year of correcting interest rates for us to get to this point. So the expectation is, if they don't raise the Fed funds rate in September, that starting the first part of the second quarter after quarter one earnings are reported, that we should start really starting to see interest rates go down.
Right, right. So it kind of goes back to, time in the market versus timing the market, right? Everyone wants to time like when interest rates are their lowest and when housing prices are their lowest, that's when I'm going to buy. Well, guess what? You're probably going to be selling at that time too. And right now, I can't think of a time in history where anyone's home has been worth more than it is today. Okay. And one of the big, well, how do I put this? Concentration of past clients and friends that I talk to that are thinking of making a move, are thinking of selling their home, are especially people that are getting into that retirement age or at their retirement age now. They're starting to think, do I really need this 3,000 square foot home for just my wife and I? We own it free and clear, or we owe very little on it. Is this a good time to sell and then pay cash for a smaller home and take whatever that spread is above, what you sold it for and what you put in your pocket, what you're buying it, and then putting that in your pocket towards your retirement. So I do think that there's definitely a need there. But generally speaking, the thing I'm seeing in the market is it's mainly people that need to sell or see a real opportunity to make a move and make some money on their house versus people that want to sell, right? Or that's part of our problem. We don't have a ton of inventory because those people that are sitting on a 3% mortgage right now that still need the home that they're in, there's not a whole lot of motivation to do anything. But for those buyers, especially, I do feel sorry for the first-time home buyers out there that with interest rates and so forth. But the nice thing is we don't have that competition that we had 2 years ago, right? Where you'd go in and the biggest frustration was, you just get your head pounded in by 14 other cash offers. And here you are sitting with a first-time home buyer that needs the house to appraise, so they can't go too far over asking. And so it's like we've gone from one challenge to the other. But I kind of like this challenge that we're in better than, going to a home and seeing people lined up down the street at an open house because they're only allowing 10 people in the home at a time. And 40, I had one listing 2.5 years ago that had 47 offers on it. So today that house would probably sit for 2 or 3 weeks until someone came along and bought it. So anyway, well, we, like you said, you don't have the crystal ball, but I just wanted to kind of come in and get your opinion on where things are and where they're headed. You think we still might see rates come up a little bit over the next month or two?
I think that given the market conditions and what I saw last year, I think that there is a good chance it could. And so if that were to happen, again, it's like, where does the opportunity lie and like what would happen in that particular case?
Right.
It could also just keep going down. It's just that we've had a couple of weeks where we've really tested all of the boundaries with inflation and employment. Like we had better inflation, we had good unemployment numbers, and the market still did not correct itself. And so I think that there's just other variables at stake.
Yeah. Lizy, what makes them say, okay, guys, it's time to reverse course. It's time to start dropping the rate. What has to happen before the Fed starts dropping that again, you think?
Well, I know that they were looking for big unemployment, and that just has not happened. And they were looking at more significant inflation reductions. So what's hard right now is that they use the CPI as a measure, but they do like a phone survey and find out what people are paying for rent without realizing that people sign 12 to 24-month leases. So like rent started going down and housing payments started going down in June of last year. So like we still, and they bottomed really, I think right now we're like, they bottomed sometime at the beginning of the beginning of this year. And so we just have like a 10-month lag on where the data gets. And then at some point they're going to realize the economy is growing too slow. But
Mhm.
at that point in time, we will have unemployment. We should have other things that require stimulation
Mhm.
and require spending. Yeah.
With the interest rates going down, do lenders generally, or the government GSAs, do they generally start lowering their requirements to get qualified for things, or do they just tend to play with the interest rate?
I mean, they've already made changes in terms of um mortgage insurance for FHA loans. They've made those more affordable. There
Okay.
was this idea that we were going to have much lower interest rates towards the end of the year, mid of this year, and that didn't happen. They made all these changes to prevent like a refinance craze.
Mhm.
So that has actually made homes more expensive. I mean, that would be nice to see some corrections with that. You
Mhm.
know, if interest rates stay high, they'll create more affordable mortgage products like a 40-year, 50-year, maybe ARMs. But a
Mhm.
lot still has to happen. And there's just not, like, for me, there's just nothing to go off of. Like, I have nothing to compare to.
And that's a good point. Normally, when you see interest rates go up, you'll see more creative financing, like you were saying, more of the ARM stuff, more of the 40-year. I remember that was starting to get pushed up. But right now, it all you hear about is just the real basic fixed stuff. The 30, no one's even treading into the more creative stuff, it seems like. Is that, am I right on that?
Yeah,
Or
it's because there's just not enough motivation to. So, like, if you know that
got it.
people are going to have to refinance in a year to 2 years, you don't want them to be in an ARM because you don't really make any money until they've had it for 3 to 5 years.
Got it.
Right. The idea with an ARM is that they have it 3 to 5 years. You've kind of like you've recaptured your investment, and then hypothetically the market should be worse. So maybe you're making double what you would have made.
Right.
And so that's the idea. So if the idea is that now they're going to refinance like in a short period of time, there's no yield for ARMs.
Yeah. Yeah. How pissed are those people that 5 years ago did a 5-1 or 7-1 arm right now?
I mean, there wasn't really a whole lot of them, but I mean,
Okay,
the
good.
people that didn't buy in 2018 because they thought the market was going to crash, those people are upset, I think.
Yeah. Yeah, definitely. Okay, well, like I said, I didn't expect to have the crystal ball, but I just wanted to give my clients some clarity on what's going on. Obviously, if anyone out there is thinking of making a move, call me or call Lizy, or anything that you need to do with your mortgage or questions about your mortgage, then obviously Lizy is your gal. So I appreciate you coming in today and sharing with us where we're at with everything. There's definitely a light at the end of the tunnel now that I'm starting to see with mortgage interest rates. Yeah, we might have a little more pain, but I don't know. It just feels a little different than it did 3 months ago. We're starting to see some signs that maybe some things are turning around that we were hoping would turn around, right? So anyway, thank you, Lizy. I appreciate you joining me, and we'll check in with you once a month and just kind of keep tabs on this thing and keep our folks informed like we always do.
Love it. Love it,
All
Bob.
right,
Thank you guys.
you
Appreciate
bet.
it.
Thanks, guys. Talk to you soon.